Hey folks, Dan Frio here, the rate update. Today is March 8th, 2021, and really not much news out on the mortgage rate front today, but there is some news on the housing market and some other things that we have on our economic calendar for the week. So don't go away because this news will be affecting rates this week. Stay tuned. Okay, so let's get to it. What happened today? Basically a slow day for data. But I just want to go through where we are today with rates, what the mortgage-backed securities market did, what it did for the average rates throughout the country, and then some headlines. So without further ado, let's get at it. Okay, so where are we? The headline numbers right here in the real estate section of CNBC. It says LGI Homes CEO expects housing demand to remain strong even as rates pick up. Guys, rates aren't going to get crazy. They went from 2.5. Let's say they get completely nuts and they go to 3.5. Well, 2.5 is the lowest rates we've ever seen in history. Okay, so we're off the bottom. But you break it down what the differential is in your payment, and it's not as dramatic as a lot of people think. That's the first thing. But other stuff that's going to be like, whoa, Dan, look at this data. For example, if you look at this, you look at the headlines right here saying the spring housing market just lost more than 200,000 new listings. What's a domino effect? Nobody's listing their homes because there's nothing available for them to buy. Most times people are looking to move into their first home or move up. A lot of people aren't selling and then just moving into apartments. So if you're moving up, there's nothing available up the food chain. So you can't put your house on the market unless you have somewhere to go. So that's what's causing a lot of concerns, I guess, in the market because there's just no supply. And you can see it right here. Spring housing market offers lowest supply on record. So once people start getting comfortable with a lot of stuff, they'll start putting their house on the market and it'll kind of snowball from there. I'm expecting a crazy, fantastic year when it comes to people buying homes. Also, I'm expecting a huge year with refinances because there's millions of people in the forbearance program that need an exit strategy. So if you're one of those people in the forbearance process, what I ask you to do is please give us a call. I'm going through and analyzing everything right now. I got all the information from Fannie Mae, Freddie Mac, and everybody, USDA, VA, and all that. I will have a condensed version of that out by Wednesday. And there's actually a professional video that we created that should be out probably by Wednesday or Thursday in regards to forbearances. We break it all down to, if you're into this program, what's your exit strategy? How do you get out of the current loan that you're in? You might not want to get out of your loan. You might say, Dan, my rate is fantastic. I missed my 6 or 12 months payments. They're allowing me to kick the payments down the end of the line. God bless you, take it. But those are, I talked to probably hundreds of people last week between talking, calling in, and emailing me. Their rates are 4.5% to 5%. So we can get you 3.25%, 3.5%. So you can drop your rate a full percent, put in all the back money that you didn't pay, and bring it in that you have a lower payment. Even if you go back to a 30-year term, here's why. If you kick it all the way to the end, you're still going to pay the term of your loan, plus you have a deficiency balance left over. Wonder if we put all that together, reduced your payment, and then got you on track with a new 30-year term. And then once you get a nest egg in the savings account, you go in and start paying what you used to pay. It's probably a couple $100 more than what your new payment would be, and then drive down that payoff period. So let's say we put you on a 30-year term, but once you get acclimated, maybe you can pay off your house in 20 years. Those are some ideas that we have for you. So tomorrow's video, I'm going to post a midday video in regards to forbearances, the guidelines, and then like I said, we have a professional video coming out soon. So let's get on to what happened in the MBS arena. Well, first thing is, here was a study that was done on people receiving the stimulus check and what they plan on doing it or what they did in the last time they received it. Did you know, and this breaks it down to ages, people 25 to 34, 50% of them are going to put it in the stock market. So half of the money they get, they're going to put in the stock market. 18 to 34, 40%. 35 to 54, 37%. Over 55, 16%. So you have about 30 to 40% of the money going out in stimulus money. People plan on buying stocks with it. So do we really need the stimulus checks for everybody? Something to ponder. Okay, so now let's get on to the MBS market. The MBSs were down 2 today. Basically, we were lingering at 0 all day long. Why is that? Well, there's nothing on the calendar today. Monday is completely blank. Okay, so why we watch this number? This number here, right here, represents what happened to the price of a mortgage-backed security. As the price goes down, in this case, mortgage rates go up. 2 basis points is not enough to make any differential in your payments or in mortgage rates. You need at least 8 to 10 movement one way or another to either get a better rate or a worse rate. So this is what we follow. So what I do on my channel is I watch a whole slew of analytical data, and then I try to watch that as well as charting to figure out where our patterns should be, and with the economic data coming out, where should we be? Well, today we had no data, so basically nothing happened. Some of the pieces of the puzzle that are coming out later this week are going to affect us. It's the consumer price index. This is what's going on with inflation. When you see a lot of this price indexes, this is inflation. CPI and PPI, that's what we call it, consumer price index, producer price index. So this is at the consumer level, at the manufacturing level. What's going on with the prices and the indexes? Meaning, are we having inflation or are we not having inflation? With the ease in the market right now, what they're saying is a lot of this is temporary. We have huge spikes in lumber prices. That'll cause the PPI to go up. We have a big jump in oil prices. That'll cause it to go up. If you look over here, you're going to see consumer price index excluding food and energy. So if you take out your gas price, how much you pay for your gasoline, and your food prices, how much is the inflation on all the other stuff? Okay, well, it's kind of not, because the reason why they do this is because these fluctuate big. So they strip those out and say, what is it just on average, other than these 2 factors? Well, these 2 factors are a big part of our life. You have to drive and use energy if you fill up your tank to get to work. I was on my way to work today. Gas prices about, not too long ago were teetering in the low 2s. We just topped 3 today. I went to the Costco the other day. I had a record Costco bill. So that, just to give you, kind of put it in perspective, it's a part of our daily lives. So if those prices are going up, it's going to hurt our pocketbook. But let's get back to this. So these numbers on Wednesday and Friday are going to, dictate some things on what's going to happen in the market. We blew past all the technicals. Let me just throw out some things in this charting here, just to kind of make sense of some things with you and for you. There's lines that go across here, and usually we only see about 2 or 3 of these, but here you're going to see about 8 of them. And what all these lines are, these are called Fibonacci levels, and these are usually should be our resistance levels up and down. Okay, so here's what I mean by that. When the market's doing really well, this will put a lid basically on to where it should trade, where this bond should trade. So if you see here and here, we hit that ceiling and we stopped. It was a resilience level on the upside. Okay, and then we have a resilience level on the downside, and that was right in here. You can see we teetered around through that. And if I go longer term, you're going to see why this line or Fibonacci level was put in place. And then we have other indicators, and that's this line here, which is the 100-day moving average. This is the 50-day moving average, this black line here. And this brown line here is the 25-day moving average. All of these are technicals that us chartists follow, and these usually give us some really good indicators on what's going on and where we should be trading. They haven't lately. And you talk to any economist, any chartist, any person involved in this, and they're going to be like, there's a disconnect right now with a lot of things. The things playing havoc on the market is right here, the Treasury yields. And you're going to say, Dan, you said that we don't even watch the Treasury yields because they do not determine, or they're not a factor in mortgage rates. They're not. I emphasize, they are not. But they have a trickle effect through the markets. This doesn't have a complete correlation with your stocks. But did your stocks take a beating in the last 2 weeks? Yes, they did. Well, Why? Is because the 10-year Treasury yields are in record territory. Not record territory, short-term high territory. This number not too long ago was 0.8 to 0.9. So we've doubled the yield on the 10-year Treasury probably within 2-3 months. That's a rapid increase in the yield of 10-year Treasuries. I did several other videos explaining how this correlates with mortgage-backed securities and stocks, so check that out on one of my previous videos. But when these yields start to go higher and higher and higher, people pull out of other investments, such as mortgage-backed bonds and stocks, and they load up in the 10-year Treasuries. Okay, so that's why this plays a trickle effect into bonds or mortgage-backed securities and the stock market. Okay, so that's what's going on right now. So tomorrow, the economic news out is really nothing, so we should have pretty much a flat day tomorrow. But you're going to hear some terminology coming out that's, you might hear of fleeing to safety. Okay, what's happening is there's unrest in the Middle East. Go figure. And we bombed Syria. And that's going to have a ripple effect through the economy, and the oil prices are going to start spiking and other things, and that's going to cause even more inflation, and the tables keep turning. Just for kicks, do me a big favor. Go back and watch the presidential debate, say back in 70s, and you might even see Ford or somebody on there, and they're talking about the Middle East and oil. So guys, do they really want to fix this problem? I don't think so. They would have done it in the last 50 years. So that's just my little tidbit in there. But that's what's going on with mortgage-backed securities right now. The intraday, we were flat. Let's see how the day went. Was it volatile? It was pretty volatile. Look, we went from 100.45 up to 107.2. That's a 30 basis point run. And then we came down, stagnated, and so forth. So again, out of the gate, we were here, moved way up, down, and then we ended up right in here. So, but the good news is we ended up on a big candlestick of green. That means there's more buyers than sellers. That is going to drive up the price and down the yield. Okay, so that's what's going on right there. Economic calendar we went through, and the infamous, what everybody wants me to go through on the national averages of rates. This is published just today. I just actually got it, and that's why my video is a little delayed. So what we go over here is the chart on what the national average, they compile throughout the whole country and come up with what are the average rates out there. So this is just to give you kind of a benchmark on where things are. So 30-year, and these are all 30-year. I don't have the 15 years, but just assume they're probably about a quarter lower than this, maybe 0.375 lower than this. And I'll start trying to figure out if I have a way to show those to you. I'll reach out to this company and see if they have 15-year charts. But right now we got the 30-year conforming at 3.22, the jumbo at 3.2, FHA 3.23, VA 2.78. We have a 1-day, 7-day, and a 4-week delta. Delta means change. So in the last day, trading day, rates have went up 0.04. Okay, that's what 4 basis points mean. It's the 100th decimal. So it's 0.04, 0.04, 0.03, and down 0.01. Basically, E doesn't really matter. Those are irrelevant. Again, same here on the 7-day. Other than the jumbo went up 7 basis points, so it'd be 0.07. There's nothing really different. Look at the 4-week. This is a month. On average, rates went up a third over the last 30 days. And you can see we pretty much bottomed out right in here, right in December, and we've been upticking since. Okay. The good news is we're still below. Last year at this time, we were averaging about 3.8 across the board. If you see it in here, right now we're at 3.2. So we're still, a little over 0.5% lower than where we were at this time last year. So it's not catastrophic. The world's not ending. You missed the bottom. You missed it. Do I think it's coming back? I do not think it's coming back. I think we're going to stabilize probably back in this range here. So if these numbers make sense to you and you're still looking to do something, we would love to help you. I just posted this out just a little bit ago, and if you want to see some newsletters, check out my Facebook, my Twitter account, and so forth. You can find this information there. Let me show you how to get a hold of me and my team. The best way to do it is go to therateupdate.com. But before you do that, I'm going to ask you a big favor, 3 things. Give me a thumbs up. It's helping. You guys are helping huge. We're getting thousands of calls a day. It's crazy. and our subscription base is hitting about 100 a day. So thank you guys so much for watching, reaching out, referring, and everything. So please give me a thumbs up, subscribe down below. That helps the algorithms get me out there more, and hit the bell so every time I post a video, you get an alert. But how do you get a hold of us? I have a lot of ways, and it's really simple. Go to therateupdate.com. Don't Google me, guys. I have my own website. I am with Preferred Rate. But I have my own website to make it simpler for you guys, how to find me, how to use all my functions. So right now we have a mobile app. This mobile app is working, and within the next 3 to 6 months, this will revolutionize the mortgage industry. It will be second to none. But get a glance at this. This will actually, you can be live. You can know what's going on with your loan at all times. Realtors, if you're partnered with us or you're looking to partner with us, use this. And you can partner up with us. So if you have a client, you can click through and we're all on the same page. We get live feeds and live events and milestones on what's going on with the loan application. There's all kind of tools here. If you're like, I just want to click and apply online, you can click the Apply Now button right here. If you want to call us, one of the best ways to do it is give us a call. Our phone number is 844-775-5626. Go up here. This is a new function that we have, and we're getting about 10 to 15 meetings a day. Go in here and click one of the meetings that you need. You should only need about a 15 or 30-minute consultation. You shouldn't need an hour. Be more than happy to talk to you for an hour, though, if you need it. But this is a way to go in and set up an appointment based on my calendar of availability. We can Zoom most of the time, and we go over. You can show me your mortgage statements and you ask me any questions. You, your spouse, your significant other, or yourself. And we a lot of times what we do on here is we debunk a lot of the misinformation out there that you hear. So that's a new feature that we just came out with. But if you want to reach me, one of the best ways to get me is just shoot me an email. My name is Dan Frio. My email address is dfordanfrio@preferredrate.com. One thing I am doing, I'm looking to expand the Frio team into the Orlando area. I just purchased a property down on Cocoa Beach, and I'm looking to expand from there a little bit south over to Orlando and a little bit up maybe toward the Daytona Beach area. If you're a mortgage advisor in those areas and you like to talk on how you can become part of our team, I'd love to hear from you. Shoot me an email. Maybe we can do a Zoom meeting. You can ask me any questions on how we do business, how we fund business, what's our underwriting like, what's our comp plans, and everything else. Love to hear from you guys. So if you're a mortgage originator out there and you're looking to partner up with me and my team, I'd love to have you. If you're a realtor out in that area, or we're licensed right now about 30 states in the country. If you're a realtor wanting to get involved with us on how we can help you co-market, co-brand, and do things to help drive in more business your way, we'd love to hear from you. So other than that, God bless, guys. Have a great day. I will see you tomorrow. Bye-bye.